Okay, we're going to get started now. So good afternoon, everyone. Good morning still for some of you as well. And welcome to today's webinar, Take Control of Your Facilities, presented by Sightlines Associate Director for Member Services, John King. My name is Eric Nolan. I'm the Senior Marketing Manager at Sightlines, and I'd like to thank you all for joining us today. I'll be moderating today's session as we first revisit last month's webinar, Why the Roof Hasn't Caved In which we discussed the latest facilities trends and key factors for why some of those dire life cycle predictions haven't played out in the industry. And due to the robust reaction and the questions that we received following that session, we'll then explore the tools that we offer that have helped institutions avoid those major breakdowns and deferral and ultimately allow finance and facilities leaders to more effectively align space, capital, and operations on their campus. Now, before we get started, let's quickly review today's agenda. First is a quick overview of Sightlines and our database of over 400 institutions across the country, totaling roughly 1.5 billion gross square feet. We'll then revisit some of the trends and analysis from our Why the Roof Hasn't Caved In webinar, highlight ROPA Plus, which is our tool to measure and benchmark facilities performance, and lastly, explore some success stories of institutions that have been able to use these tools to manage and even get ahead of the challenges they face on campus. Lastly, before we get started, I'd like to remind you all that if you have any questions or comments during the presentation, please don't hesitate to share those with us. I'll be monitoring them throughout the presentation, and we'll do our best to address each and every one of them towards the end of each section. To submit a question or comment, just simply enter it in the questions box on your GoToWebinar window pane, and they will be sent directly to us. And to answer one question up front that we typically receive, following today's session, each of you will receive an email that contains links to both the presentation slides and webinar recording for your continued engagement with this material. So keep an eye out for that email tomorrow. And with that, I'll pass it off to John to get us started. So take it away, John.
Thank you, Eric. And thank you, folks, for joining. Good afternoon to some and good morning to others. Again, my name is John King, Associate Director of Member Services at Sightlines. We'll talk quickly about who we are as a company. And first, I must say that these are exciting times in facilities and higher education. We're seeing some unique enrollment trends, as most of you know. We're seeing aging facilities, backlog growth. We're seeing funding not rebound to the same level since post-recession, pre-recession. And so it's exciting times in facilities and higher education. And we're going to go through a lot of those trends today and talk about some of the solutions to those trends. Sightlines is a facility asset advisory firm. We pride ourselves in our analytical rigor, providing a common facilities vocabulary, a consistent methodology, and a common platform. I always say that we use a consistent methodology with customized results. We identify ways to use capital more strategically and identify opportunities to improve operations effectiveness throughout an institution. We pride ourselves in separating fact from fiction on key issues relating to operations performance, annual funding needs, project backlogs, staffing levels, etc. We document these trends, provide consistent measurement, credible benchmarking, and track progress to goals. Our membership is an annual membership, and as institutions elect to modify policy to advance facilities and advance the physical assets on campus, it's important to track that progress to the goals we set. And through this process, we can do that each and every year. Our membership has grown quite substantially over the last 15 years in the business. You can see that our membership includes colleges, universities, consortiums, and state systems. We pride ourselves on having a database, the top schools across the country, 14 of the top 20 colleges, 15 of the top 20 universities, a number of the flagship state universities, many of the Ivy Plus schools. You can see any state in the United States in the shade of blue. We have a number of institutions in our membership. We're also working with a number of schools in Canada as well. Right now, 450 colleges and universities in K-12 strong, and we maintain a 93% ROPA member retention in 2014. Also note that 100 institutions became new members since 2013 using our core ROPA methodology. That's who we are. Again, we're growing with our humble roots in the Northeast outside of the Boston area, and we've grown to an international firm. As Eric mentioned, about a month ago, our Vice President, Jim Kademis, gave a webinar followed by a white paper on why the roof hasn't caved in. There have been quite a number of doomsday scenarios out there for over 30 years. A lot of experts were forecasting that given the construction trends in higher education historically, that we're going to be reaching key thresholds of apocalyptic proportion. And honestly, those trends haven't come through. And Jim mentioned a few key factors as to why we believe at Sightlines that these trends haven't come to fruition. And we'll go through some of those trends and talk about the reasons why in the next coming section. So let's jump into some of the trends we're seeing across higher education. When we look at when buildings were constructed since the late 1800s in higher education, there are two significant waves of construction. After post-war, the GI Bill response in the late 60s, early 70s, we saw a significant increase in construction across higher education. These buildings, as you all know, are oftentimes the flat roofs, the casement window, the pneumatic controlled buildings that were not built to last. They were built in a hurry to respond to this pressure to expand higher education. And these buildings are all 40, 50 years old today. We've seen through our analysis that when these buildings come due, they come due hard and fast, and a significant portion of these buildings across higher education are knocking on our door for reinvestment today. A second wave of construction was in the late 1990s, early 2000s, again, through the pressures of enrollment, seeing a lot of construction increase in that time frame. So we have these two waves and two peaks of construction. Both are coming due today for different reasons. The one in the late 60s, early 70s, these buildings need significant reinvestment to bring them back to life. The later period in the late 90s, early 2000s, these buildings, although are still structurally sound, mechanically sound, we're starting to see some of those subsystems come due, some of the soft finishes, some of even the mechanical systems that are reaching critical life cycle thresholds. So the pressures that we facilities officers and financial officers at institutions are facing are oftentimes predicated on these two construction periods in higher education. As we look at the trend across higher education in terms of space growth, we haven't really slowed down since 2007. Each and every year we're seeing more square footage being added across higher education, even though enrollment growth has plateaued and actually is starting to decrease over the last 2 years. So we continue to be space rich. We have a continued thirst to add new space across campus, and we're starting to see that dwindling enrollment trend that we've all forecasted given high school demographic data that has been populated over the last decade or so. So space is growing faster than the enrollment and certainly creating additional pressures across higher education. When we look at what's been spent historically in maintaining these buildings from a project investment, capital investment, we at Sightlines look at funding sources, and we look at the one-time sources of funds, separate from the recurring sources of funds, annual capital versus one-time capital. And we're starting to see a rebound since pre-recession levels. You can see in 2009, we're about $5 a square foot on average across our database into capital construction into existing space. And slowly we're getting back to those levels in 2014. The interesting thing is the mix is changing. We're seeing that more of the funding is coming through annual capital to keep up with life cycles, keep up with buildings, and less of the funding is coming through one-time sources. These would be gifts, grants, bonds, those types of funding sources that really go towards resetting a building's clock. Major renovation, significant system replacements, that funding hasn't really rebounded since the pre-recession time. More of it's coming through annual capital. When we break out the trend between public colleges and universities and private colleges and universities, it's interesting. Since 2007, private schools are spending more per square foot, averaging about $6, a little more than $6 a square foot. Publics are averaging about $4 a square foot. And you can see the trend, the funding mix between recurring annual capital and one-time capital is really being dominated by the private average. Essentially, they're increasing their annual capital by over $1 per square foot, since relying more on keeping up the stewardship of their facilities, and it's a more predictable, reliable situation that the private schools can rely on each and every year to fund ongoing major maintenance and program needs across campus. Public, that recurring annual capital really hasn't changed much since 2007, and you can see that the total spend on the public side has been pretty consistent. When we look at operating budgets, they're increasing modestly. They're not keeping up with inflation. 2007, the cost of daily service operations and planned maintenance within the facilities department was just over $4 a square foot. In 2014, fast forward that many years, we're not even at $5 a square foot. So as we forecast the inflation and where it should be, the operating budgets across facilities in higher education have not kept pace. It's causing facilities leaders and facilities managers to figure out creative ways to do more with less and stretch their dollar that much further today as compared to 2007. The interesting thing too is that planned maintenance has been increasing modestly. Trying to find additional resources to put towards proactive planned maintenance within facilities is an ongoing effort across higher education. You can see it went from 28 cents a square foot to 35 cents a square foot in 2014. What does all this mean? Again, we saw those two peaks of construction. Capital really hasn't rebounded significantly. The mix of spending is changing, and operating budgets are essentially flat. What does this mean? Well, it means that backlogs of campuses are increasing. This chart is showing publics on the left, privates on the right. The blue stacked bars are looking at dollar per square foot for the backlog since 2007, and the greenish yellow line there is looking at percent change. So no matter which way you slice it, backlogs have increased since 2007. We're approaching critical thresholds. The public sector is just shy of $100 per square foot in backlog at this day and age in 2014. So to summarize these trends one more time, we're seeing aging campuses dominated by that construction in the late 60s, early 70s, as well as that additional boom in the early 2000s. We're not seeing the enrollment catch up with the increase in space. We're continuing to add space on campus. The funding has been, slowly rebounding, but again, the mix between catching up and keeping up is shifting. And our backlogs are starting to grow to significant thresholds. So why, given the situation we're in, given these trends, why haven't we seen those major failures, and why haven't we seen the predictions come true and that the roofs are caving in and that apocalyptic forecast that we've been talking about for 30 years at this point in time? Well, there are a number of reasons why Sightlines thinks it hasn't come true, and a lot of the response from the webinar that was given from Jim Kinamis last month, you folks wanted to know more about the first one, which I'll talk about now, is better data to identify and manage the most critical repair risks on campus. The data now that's available in facilities, the data that we're using to make decisions about which projects to do and which projects to defer, the data we're using to make the case to institutional leadership and decision makers on campus is far better than it was 30 years ago. And we believe that's a key factor as to why the roof hasn't caved in. And we'll talk more about one way you can use data through the Sightlines ROPA Plus model to really make the case for change and to manage these risks effectively across campus. Additionally, beyond data, we think that building systems tend to outperform their kind of stated or statistical target that we're seeing put out there by manufacturers. Meaning if a boiler is slated to last 35 years, we're seeing facilities leaders get 38, 40, 45 years out of boilers. We're also seeing that facilities leaders and directors and managers are being crafty with repairing the systems, band-aiding the systems, instead of repairing those systems in full. And through that ongoing repair, we're able to get more life out of that system before critical failure. We know that campuses are a diversified portfolio of buildings, and this risk of the roof caving in is spread across that portfolio. So in the event there is a critical failure in a building or a critical failure in a section of a building, we have the ability oftentimes to relocate the population of that building, to shut that section down, repair it, and mitigate the risk by shifting the population. We know that's not always the case. Enrollments and densities often create pressures, but that risk is oftentimes diversified throughout the physical portfolio of campus. And finally, this concept of what we call functional obsolescence of space drives investments that bring outside resources, especially to modernization and renewal. The grants, the gifts, the donations that target outdated buildings to bring them back to life, those funds oftentimes address critical needs, those reliability issues that are plagued in that building, and oftentimes that renovation will not only address the modernization of that building or the programmatic updates to that building, but also the underlying issues behind the walls, in the basement, in the attic, to preserve the legacy and preserve the asset into the future. But again, we want to focus on the first one, getting better data to identify and manage the most critical repair risks for campus. And we're going to talk about one strategy that really allows us to do that. ROPA Plus, or Return on Physical Assets, is a foundational model that Sightlines has utilized for the last 15 years of being in the business that allows us to create a strong foundation to understand, identify, and report on facilities issues. We look at metrics and data throughout the campus and put them through this model that integrates capital, integrates operations, integrates space, as well as many other factors within an institution to benchmark and to analyze the needs across campus. Within this foundation, then we can start to move forward and look at specific issues on campus. Are you interested in defining a facility's needs and capital plans through a building portfolio solution? Are you interested in documenting those project-specific issues on campus? Are you interested in understanding how well you're utilizing your academic and teaching spaces across your portfolio? Are you interested in understanding your carbon footprint and understanding ways to become more carbon neutral across campus? Those are additional services that tack right on to the ROPA Plus foundation, but we believe that it's this foundation that allows us to truly discover the issues that your institution is facing from a physical standpoint. Through the ROPA analysis, we talk about changing the conversation, truly identifying the big opportunities out there and integrating many siloed areas on campus into a model that works together. In particular, trying to think about space, capital, and operations as an integrated platform rather than a siloed approach. Think about your space profile, the type of buildings you have, the amount of buildings you have, the density of your campus, and think about whether or not we need all these buildings. What is the strategy to right-size the physical profile on your campus? Think about the capital investment. Is our investment approach tied to the mission of your institution? Is it tied to mitigating campus risks over time? How do we take the space profile and optimize that and optimize the capital profile then to trickle into the operations and find ways within operations to release savings and lower the facility's overhead on the institutional balance sheet. It's a great way to have space, capital, operations talk to each other. We don't want to think about space separate from capital, separate from operations, because they all connect and they all interact, and if you change one, you have to realize that the other two will follow suit. And so the goal is to think about your campus with these three areas integrated together. The way we do that is through the ROPA model, and again, return on physical assets is the model, ROPA for short. Within the ROPA model, we look at two different distinct buckets: asset value change and operation success. Asset value change truly looks at the financial needs of your institution. What is the condition of your buildings? What is the value of your buildings? What does it take to maintain what you have? What does it take to bring your backlog down? All those kind of financial components of managing a physical profile. Within asset value change, we look at annual stewardship and asset reinvestment. Annual stewardship is what we consider the cost of keeping up. We quantify what it takes to maintain your buildings and those subsequent building components each and every year to fund those life cycles to maintain steady state. As we know, buildings are very predictable in nature in that we know, for the most part, when things come due. How long does a boiler last? How long does a roof last? How long does a carpet cycle last? Painting, all those components that make up a building, how long they last. And we can model out what it takes to maintain all those various components each and every year at your campus using this annual stewardship concept. Again, cost of keeping up. If you're able to keep up with that target, you'd be able to maintain a steady state on your campus each and every year. We all know that it's challenging to keep up fully, and every campus across the country has an asset reinvestment backlog. And this is a laundry list of deferred maintenance as well as modernization needs that exist on your campus. And we call this, again, the asset reinvestment need, or the cost of catching up. Over time, as keep-up needs come and as we start to defer those needs next year, we start to accumulate the catch-up component. And again, there's a balance between critical backlog, life cycle needs are coming, as well as modernization. And that balance is different for each and every campus. But it's important to think about keeping up and catching up as a dynamic funding approach that each and every school needs to think about and fund into the future. Keeping up with life cycles and catching up with deferred maintenance and modernization. On the operation success side, we look at foundational model metrics, your staffing levels, your supervision levels, your maintenance materials, planned maintenance, energy cost of consumption, the cost of your facilities operating budget, all those nuts and bolts, if you will, within facilities management that go towards driving the overall cost of operations. And finally, service. This is a measure of the output. The Sightlines team will conduct our inspection process. We actually have a survey that polls campus users about their expectations, as well as look at the work order system within being used on campus, which we consider the lifeblood of facilities. What system is in place and how effectively is that system being used to help manage the work and manage the daily cost of facilities. So again, annual stewardship, the keep-up cost, asset reinvestment, catch-up cost, operation effectiveness, those daily nuts and bolts of facilities, and service the output of campus operations. And together, these various areas create what we call the ROPA model, and they interrelate with each other. The way our process works is over the course of 3 phases through the ROPA Plus process, we go through a discovery phase, a prediction phase, and a performance phase. Phase 1, oftentimes year 1, would be collecting the base data, understanding the historical trends, and benchmarking those trends against peer institutions. You'll have access to a benchmark across the 450 institutions in our database, and the Sightlines team will help you select the right facilities peers. And then finally get used to the vocabulary that we offer, as well as the important interrelationships between the various areas of data. Year 1, again, is discovery. It's a discovery process. Year 2 is prediction. This is where we actually predict in the future what's coming due, not only from a capital standpoint, but also from an operational standpoint. We can look at the type of buildings you have, the age of those buildings, the needs in those buildings, and say, using our ROPA Plus prediction process, here's what we're facing over the next 10 years. Here's what's imminent, and here's what are the needs that we can kind of think about year 5, year 6, year 7. So truly looking into the future and understanding what we're going to be facing. And year 3 is performance. And this is where we can help facilities leadership identify key areas of focus, whether that be planned maintenance, energy, sustainability, capital, stewardship, all those kind of various important metrics. We can identify the areas that are most important to this specific institution and work with the leadership to set goals, to set performance metrics, and then help the institution track towards those goals over time. So again, ROPA Plus as an integrated foundation that goes through the 3 phases of discovery, prediction, and performance. This is all done through a disciplined methodology, looking at our past performance, and we go through what we call measure, benchmark, analyze, and membership. So measurement is, again, quantifying all the data. Sightlines team will come to campus, collect and assemble the data, meet with the various constituencies on site, and really make sure that we have qualified, verified information to look at. Once we have verified information, we start to benchmark that information against peers to understand where we stand. Are we good? Are we bad? Are we high? Are we low? Are we average? Gives us that context to make informed decisions. Once we benchmark, we start to analyze and interpret those trends. And this is where we validate the information and look at the insights and perspective across the database, as well as what other institutional leaders are doing in the marketplace. And finally, again, through the membership, this is an ongoing, iterative process where each and every year we can review those goals, review the findings, and continue to hone them over time as we learn more and as the data becomes that much more condensed and easily understood. The ROPA Plus process does give our membership access to a great member portal. This member portal is a phenomenal tool that allows each and every institution to set up key dashboards, to set up plenty of users, to create custom benchmarks, to access the sea of information out there across our 450 institution database. And it's all at your fingertips to create more support, to create more access, to create more context as we start to tell the story to the institutional leadership. This member portal is available to each and every one of our members, and it's an immense tool that is highly valuable across the database. To quickly touch on some of the, I mentioned some of this, so I'll go quickly through the slide, but the data elements we collect, the foundation of ROPA is really the building inventory, the physical assets you have, and the attributes of those physical assets. We'll be looking at size, type of building, complexity. We'll look at the mechanical systems. We'll look at when they were built, any major renovations, whether it's heated by a central system, independent system, how is it electrified, all those attributes that tie into the central infrastructure of campus. The building inventory is really a critical component for the Sightlines ROPA model. We'll look at deferred maintenance, whether it's your assessment, whether it's an in-house assessment, whether you contracted with an FCA group, or if there isn't one, Sightlines will help model what we think the deferred maintenance and asset reinvestment need is for your institution. We'll look at staffing, the facility staff under the facilities umbrella, who's out there helping, the FTEs that are supporting the daily operations. We'll look at your work order system, not only the type of system and how well it's integrated within facilities leadership, but also what are you getting out of that information? Are you able to use the work order information to make data-driven decisions, to target projects, to target strategies, to integrate with institutional planning? All that information we'll take a look at through your work order system. We'll look at your energy profile, monthly unit cost, monthly consumption by fuel type, by meter, to really understand what opportunities exist out there from an energy standpoint. We'll look at your financial situation, collecting audited financial statements. We'll look at your facilities operating budget. We'll also look at your capital investment history. All this will collect a 5-year snapshot to look at the trends across the ROPA spectrum. And to give you a sense of some of the information that we'll start to extract as well as report on, we can start to benchmark attributes of your space profile. Look at, for example, the amount of space per student. How many square feet do you have per student? How is that relative to your peers? How is it relative to the database? We'll look at the average building size. You know, how many square feet per building on average is your institution? Is that below or above your peers? And think about the implications behind how densely packed your campus is, the types of buildings you have, the size of your buildings you have, the implications those variables have on your capital plan, your operational strategies, and the ROPA model itself. For example, this campus, you know, more space and smaller buildings equals a savings opportunity. Is there a way to right-size the size of campus looking at, you know, renovating through replacement? How do we get rid of some of these smaller buildings that may be full of deferred maintenance that are programmatically obsolete, replacing those smaller buildings with fewer larger buildings that will lead to a smaller footprint in general, aligning the total space per student metric, and also creating operational efficiencies. Having fewer larger buildings oftentimes leads to a more efficient operational structure. Maintaining a bunch of small houses with a lot of nooks and crannies can lead to quite the operational and capital headache on campus. We are able to define, as I mentioned before, what it takes to maintain your campus from a building component lifecycle standpoint. We founded our annual stewardship model based on the notion that not every building, not every campus is created equal, and we need to understand the nuances of each campus before we can come up with a customized investment target. Sightlines, when we were, you know, in the inception, you know, the early stages of our company, and we looked at, there were a couple of studies out there. I think Nakuba at one point led to the 3% replacement value rule of thumb, essentially saying if you were able to set aside 3% of your campus's replacement value each and every year to put towards annual stewardship or the annual investment, you would be able to depreciate your asset over a 33-year period. It's a financial approach. It's a good kind of educated guess, but it doesn't look at the specifics of the buildings you have. Do you have a lot of science space on campus? Do you have a lot of research space? Do you have a lot of, you know, liberal arts dormitory space? Understanding the makeup, the functional makeup, the technical complexity of the systems, the age of your components, age of your buildings, all play into what it's going to cost to maintain the life cycles as they come to. So Sightlines is able to use our methodology in our database to say, what does it take to maintain all of the envelopes and all the mechanicals on your campus, as well as all of the space needs on your campus each and every year. And this assumes you're going to replace every boiler, every roof, every carpet as they come due throughout time. We know that that's fiscally irresponsible, it's not really fiscally attainable, and Sightlines realizes that there's a discount that we can apply to our annual investment target. What this means is that we know that we can stretch life cycles. We know that there's a campus tolerates some degree of what I like to call charm. Charm is components that are less than perfect. Think about, you know, the cobwebs in the corner and the cracked tiles on the floor. And not everything needs to be perfect all the time. There's a tolerance for charm on campus. And the most important factor is this concept that I mentioned before of functional obsolescence. This means that we can discount the need because we know that spaces will churn faster than life cycles come due. Programmatic pressures oftentimes are coming at us in facilities faster than things come due from a life cycle standpoint. So, you know, faculty members or students are demanding new technology, new classroom arrangements, new seating arrangements. All that kind of demand is causing facilities to churn space very quickly. That funding oftentimes comes through the one-time sources, the gifts, the grants, the bonds, to do that type of modernization. So from a facility stewardship targeting standpoint, we can discount life cycle to reflect that. And you can see that this example campus, that discount is pretty significant, where we keep intact more of the blue envelope mechanical, but discount pretty heavily the space and programming need for that campus. We then can measure how you're doing against that need. We'll look at your funding both from a recurring standpoint and one-time standpoint to say, how is your funding lining up towards those targets? Bottom being that discounted life cycle target, top being that equilibrium approach. And understand, are you increasing your backlog? Are you able to get within the zone, in the middle, and lowering your risk profile, balancing your backlog? Or are you able to get your funding above the top of the line and truly increasing the net asset value of your campus? And we'll take a look at that. As I mentioned, we can also forecast the future and look at what needs are coming due. And in particular, this campus, we're looking at their current need, their renewal need, and their modernization need. And so we can look at the next 10 years for that ROPA Plus prediction. So it's really exciting because we can look at 5 years of history and look at where you stood versus those targets, as well as look at 10 years in the future to see what's coming due. And it creates a very robust picture of where we stand from a capital needs standpoint, alluding to the backlog and the asset reinvestment requirements that the institution is facing today and into the future. We can also look, as I mentioned, your daily service and the cost of operations and identify where savings exist. For example, this institution, we knew that their daily service was somewhat in line with peers from a dollar per square foot standpoint. Their average was about $3.40 a square foot in daily service. This institution was right there, 10 cents above the average. But we also knew that when we looked at the specifics and dug into it between maintenance, custodial, and grounds, there was an opportunity within the maintenance department. And we looked at coverage, maintenance staffing coverage, GSF per FTE. We looked at maintenance supervision, how well the maintenance department was being supervised, as well as the cost of material to really identify areas of opportunity to optimize that maintenance component to make sure that operationally the daily service needs were in check with peers into the future. We'll also look at energy consumption. Again, looking for opportunities to reduce energy. This example campus here on the left-hand side, BTUs per square foot. The blue is fossil, the red is electricity consumption. Comparing that to peers, they are consuming more than peers and they're increasing at a faster rate. So thinking about where we can focus our efforts, which buildings are either energy hogs, which buildings are out of date with mechanical systems, which buildings potentially could be removed from campus, all leading to opportunities to reduce consumption. And then the key is once you reduce consumption and create savings, recycle those savings back into the facility's budget in the form of either planned maintenance or annual stewardship recurring capital. So how do we take these savings that we're finding in operations and keep those in facilities to allow those savings to work more for stewarding our buildings into the future? I mentioned, we'll take a hard look at the service process and the work order system that is the lifeblood of the facilities leadership team, and understanding what we can extract from that system to, again, lead to data-driven decisions. Again, hot, cold calls, frequency reports, costing reports, labor reports. Where are the opportunities within the work order system that allows us to target capital funding, that allows us to make operational changes? And there's a great wealth of information in that service process and that work order system to help us understand where to point. We can also look at how that system is set up to make sure that not only is it set up optimally from a management standpoint, but also are we communicating the process to our campus users? Are campus users integrated in the work request system, and is there a feedback process built into the system that allows communication to be had between work requests that are being executed by facilities and those individuals that are requesting that work from the get-go? So understanding that setup and linking it to customer satisfaction is very important. The Sightlines team then will do our campus inspection, and we'll look at things that general repair, how clean buildings are, the exterior condition, mechanical systems, and we roll that up into our campus inspection and index that. And finally, we will issue a customer satisfaction survey. And this survey, again, allows us to understand expectation levels across campus. It allows us to understand whether or not that feedback process I mentioned earlier is up to snuff, if you will, for the users. And it allows the facilities leadership team and the finance team on campus to really make informed decisions based on what the expectation level is of the users that you are managing and working with each and every day. As we roll all of this stuff up, I know I'm throwing a lot of information at you in terms of ROPA, but as we think about balance and the total facilities intelligence solution through ROPA Plus, it's all about balance. It's all about looking at the resources available and making sure we're putting those resources in a balanced process. This radar chart you look at allows us to make sure that balance is in check for each institution. It puts those 4 key areas of ROPA on a diamond: annual stewardship, asset reinvestment, service, and operations effectiveness, and allows us to think about things such as when stewardship falls, failures increase. When we don't have the recurring capital and that commitment to keep up, we're seeing failures increase. We're also thinking about things like it will increase operations demand. It will decrease customer satisfaction. It will drive decisions that oftentimes allow space projects to win over systems projects, and it will cause backlogs to continue to rise. As we focus on stewardship and making sure that stewardship is a key component of our facilities solution, we reverse that trend and rebalance the ROPA process. We focus on the right project selection, we decrease operational costs, we increase stewardship, we reduce emergency work, increase customer satisfaction, and create a lot of flexibility in project selection. Again, making sure that we're choosing the right projects that meet the needs of program, but also meet the needs of preserving our assets and ensuring that the campus projects are set up to allow this institution to stand the test of time in the future.
Hey, Dan, we had a few questions that were submitted. The first of which is from an attendee who's looking to get a better sense for the timeline of this entire process, really from that data to the delivery of findings.
Yeah, great. That's a great question. Often I get that question. The process that we go through is quite accelerated. Once the member services team is set up to get on campus, it goes from campus visit to what we call the qualification stage. That allows us to verify the data and the results and the trends to make sure that the facilities team and the finance team can sign off on these data points and say, yes, this is right and this reflects my campus. That initial data collection to qualification takes about a month. From the qualification to the preliminary findings report, where we start to benchmark performance, we start to look at those trends, find those opportunities for savings, and report on the initial findings. That next step from, again, qualification to prelim is another month, and then from preliminary to final, it really depends on how the institution wants us to present the final and which audience. Say there's a board of trustees meeting that's in the future, we can certainly save it for them. Say we want to brief the president's cabinet, we can do it the next time they meet. So it really depends. But after the preliminary results are done, finalizing the report and delivering the final presentation is really up to the institution. I always say, though, it's a 1 month to qualification, 2 months to the preliminary findings report.
Awesome. Thank you, John. Second question, this is coming from an attendee who is currently going through an update of their campus master plan initiative, and they're wondering how this analysis can factor into that process.
I think some of the most exciting integrations we've seen with master plans have come through ROPA Plus prediction. We know that oftentimes master plans will identify buildings that are going to be renovated, buildings that are going to be demolished, new construction. I mean, that's all the main point of why schools go through master plans. And we oftentimes forget about everything else. You know, we get so fixated on the 4 or 5 buildings that are identified in this master plan that we lose sight of the fact that the other 10, 15, 20, 30 buildings are still knocking on our door, you know, whether it's today or next year or in 5 years, there are things that are coming due. And so ROPA plus prediction can integrate beautifully with a master plan. I always think about it as like a strand of DNA. You know, they kind of wrap around each other, and through that process, we can report on a comprehensive kind of 10-year, 20-year, 30-year outlook of what the institution should be thinking about to make sure that we're not only focused on those major master planning initiatives, but also making sure that the rest of campus is receiving the attention it needs to preserve the legacy, preserve the asset, and to stand the test of time.
Okay, thanks, John. That's all the questions we have so far.
Okay. Let's quickly jump into the 5 strategies for success here. These strategies are time-tested. We've been talking about these for quite some time, and no matter where you stand on the spectrum of higher education, no matter what your campus looks like and the condition, these strategies we feel like every campus should get behind to think about ways to optimize their resources and to put them in the best position moving forward. Really, there are 5, like I said. Build strategically is number 1. Less can be more is number 2. Looking ahead is number 3. Keeping up or keep up is number 4. And then rewarding savings is number 5. And I'm going to go through these in a bit more detail one by one, starting with less can be more. Taking a hard look at your physical inventory and making sure that it's right-sized. Do we have the amount of square feet we need? Do we have too much? Do we not have enough? But really thinking about processes that allow us to potentially create policies that are no net new space policies or no net new backlog. A lot of schools are really thinking outside of the box when it comes to space policies, and more schools are considering a policy that allows us to, if they want to build a new building, if there's a programmatic need, a true programmatic need to build a new building, that new building needs to create no net new space, in that they need to remove a consistent building from the inventory that's the same size, or focus on their existing assets altogether and not build new. So really creating that policy that we're good with what we have now, and we're going to focus on optimizing the current footprint on our campus. Additionally, another variation is, you know, if we want to build a new space on campus, a new building, then we need to commit to reducing our current backlog by that same investment. So say the building is a $30 million academic building, then we need to find a way to reduce our current backlog by the same amount. We're seeing a lot of schools think outside of the box about less can be more, and a great example here is some data that is from a public institution in the Northeast that through hard decisions, through great policies, have found ways to reduce their current backlog by 24% since 2009. This didn't come easily. They had to make tough decisions about which buildings are truly legacy buildings on campus that are going to stick around versus which buildings could either be renovated through replacement versus which buildings just are going to be going away and we're going to get by without this building. And through that strategy, through the dedication and persistence and getting the buy-in from the top, they were able to reduce their backlog from almost $2 billion to just over just shy of $1.5 billion. So this is a public institution, and again in the Northeast, they're able to buck the trend, if you will. We show the public sector's backlog increasing to almost $100 a square foot this year. This institution is going the opposite and positive direction. State systems. The UMaine system is thinking critically about their old buildings. All buildings that are over 50 years old are being placed under this immense scrutiny. Do we need these buildings? Are they historically significant? Are they a legacy building? Are they heavily utilized? If the answer is no, then they're thinking about divesting into these assets, just making sure that they're right-sizing their campus and focusing on the space that is programmatically still significant and removing the space that's programmatically obsolete. Building strategically, this campus, we identified that their density, the busyness of campus was 4 times that as their peer average, significant dense campus. They were focusing on, it equated to 7,500 more users on their campus each and every day. It equated to them to push into a space utilization assessment, understanding how well they're utilizing their teaching space. And as you can see, the squiggly line here shows over the course of a day from 8 a.m. to 9 p.m. I think. I'm trying to get my military time straightened out. When were the peaks happening? You can see there were two primary peaks, one late morning, one early afternoon, where they're peaking out to 80–90% utilized, which is really kind of tipping the top of the charts in terms of utilizing teaching spaces in higher education. But what it came down to, before they committed to building new space to expand their footprint, they wanted to take a hard look at the current spaces they had, in particular the teaching spaces. And this was a chart that looked at the distribution of rooms by size. You can see 0 to 25, 26 to 30, 31 to 35, 36 to 40, and over 40. And these are capacities. You can see that this institution had the majority of their space, their classrooms are either 31 to 35 capacity big or 36 to 40. When we looked at the needs of their enrollment, the vast majority of their class sizes were less than 25 students big. So there was a misalignment between the type of classrooms they had and the types of classes they were teaching. And so before they built new square footage, they thought about how can we use the existing square footage more effectively. Well, that created a dynamic where they looked at some of these larger classrooms, the 31 to 36 size and 36 to 40, and thought about merging, say, 3 of them, in, 3 larger into 4 smaller, and creating more capacity out of the existing square footage by right-sizing their classroom spaces with their enrollment trends. So interesting dynamic where enough square feet, but functionally speaking, these academic spaces were obsolete when it came to today's program that faculty and students are demanding. Quickly talking about, also not only building strategically, but repairing strategically. The historical way of assessing the needs of campus was you would do a technical assessment, document the deferred maintenance, document the project need, and then go right to project selection. By doing that, we missed a few key strategies. We failed to harness, oftentimes, the kind of innate, detailed knowledge that the facilities leadership has, facilities management has on campus. We oftentimes don't tie projects to mission and strategy and master plans. We often ignore financial capacity, and by doing this, we miss opportunities to really optimize capital resources. So what we think institutions should go through is a portfolio approach where we start with a technical assessment, but we integrate the technical needs into creating building portfolios. Building portfolios is a way to segment campus into distinct buckets of buildings. And from those buckets, we can then develop a multi-year capital plan where we can start to appropriate funding to each one of those buckets. And it's a great way to allow institutional leadership to align their goals with projects without having them specifically identify the projects. Once we identify the funding plan through portfolios, then the facilities team can identify which projects we want to do to meet the goals of those portfolios over the next 10 years. So it's really an interesting way to ensure that our technical needs on campus are aligned with strategy, master plan, and allows the institutional leadership to really appropriate funding to a fewer select buckets of buildings as opposed to tying specific funds to specific projects. We all know that oftentimes we run out of money before running out of buildings, and this is a great way to prioritize which areas of campus receive the funding needed to bring them back to life. Looking ahead, trying again to understand the attributes of your current profile. This campus had a lot of space that was either under 10 years old or 10 to 25 years old, so the train's coming down the track but not quite there yet in terms of deferred maintenance and keep-up costs. And as we look into the future, we can see that their target really plateaued at about $1 million from 13 to 16, but as that train got to the station, those needs started to spike significantly in the out years. It allowed this institution to plan ahead to make sure they're having the right conversations and positioning their resources in a way that allowed them to tackle these mountains into the future. We can then show you those needs rolled up versus your capacity and understand again the detail behind the needs, not only when they're coming due, but what types of projects, whether it's current need or immediate need, whether it's remaining need or life cycle need, or whether it's modernization and infrastructure on campus. Really understanding the balance of needs, looking into the future is important. And then finally, keeping up matters. Regardless of where you stand, as I mentioned, these 5 strategies, keep up is critical. And as I mentioned, it's an important factor that if it is not in balance, we start to see failures rise, customer satisfaction decrease, as well as backlog growth. So keeping up is a really critical component. And when we start to look into our database, $1 invested into planned maintenance from an operational standpoint equals $2.70 in daily service operating costs. There's a compounding impact of investing into planned maintenance, part of keeping up. On the other side, from a capital investment, $1 invested into annual stewardship keep up, maintaining life cycles as they come due, again equals $3 in capital backlog catch up. Waiting for things to fail, running to fail method oftentimes leads to $3 more than keeping up with those needs consistently through stewardship. And then finally, rewarding savings. Rewarding savings is an important concept that as facilities make decisions to rebalance their profile, to focus on stewardship, to focus on ways to optimize operational resources, making sure that any savings attained, whether that be through energy, whether that be through staffing alignment, whether that be through rebidding contracts, those savings should stay in facilities. And those savings then should support stewardship and planned maintenance to help propel those 1-to-3 ratios that we just talked about into the future. You can see this campus did that. A quick example, we looked at their project mix broken down by system, and we can see that as they took their savings and reinvested those savings back into facilities, they focused on increasing investments into building systems, building envelope, and utility infrastructure over the last 3 years, FY 10, 11, and 12. And so they created that policy that allowed them to keep savings within the facilities team. The last thing I'm going to say is that Sightlines publishes the state of facilities in higher education each and every year. The new publication is slated to be published and released mid-November, and if you haven't done so already, I encourage you to download the current one as well as look forward to the new one that's coming out in 2014. It elaborates on a lot of the information and trends we've talked about today. It also will allude to those 5 keys to strategies for success and gives you a lot of great context of what we're facing in facilities across higher education today and into the future. With that, I'll turn it back over to Eric. Thank you very much, and I'm happy to answer any additional questions that have come up throughout the webinar.
Thank you, John. That was great. All right, so that wraps up today's session. We're running a bit over, so I'll quickly kind of run through some of these final details. John mentioned if you have any additional questions, please feel free to continue submitting those. And while we wait for more questions to trickle in, I'd like to let you all know that you will be receiving a post-webinar survey at the conclusion of today's session. This survey is designed to not only get your thoughts on the content of the presentation, but also get a sense for the challenges that you face on campus, and with those in mind, what topics you'd like to hear from Sightlines at future events and future webinars. Just kind of reviewing the question box, it looks like we've addressed all questions that have been submitted. So again, I'd like to thank all of you for joining us today. I hope that you enjoyed the session and found the information valuable as you explore ways to create a new facilities conversation on your campus. In the meantime, please don't hesitate to contact us via our website, www.sightlines.com, or directly at insights@sightlines.com if you have any additional questions following today's call. So I'd like to thank you all again, and I hope that you have a great day.